Hey everyone, welcome back to FX Limit, your ultimate resource for mastering the Forex markets. Today, we're tackling a topic that's absolutely essential for anyone serious about Forex trading: interpreting inflation data. Inflation is one of those key economic indicators that can send waves through the currency markets, and if you know how to read the signals correctly, you can gain a serious edge in your trading. So, let's dive in and break down the best strategies for interpreting inflation data in the Forex markets. First off, let's talk about what inflation actually is. At its core, inflation represents the rate at which the general level of prices for goods and services is rising, and subsequently, how purchasing power is falling. Central banks, like the Federal Reserve in the US or the European Central Bank in the Eurozone, keep a close eye on inflation. That's because they aim to control inflation to maintain economic stability. For Forex traders, this is where things get interesting. Because central banks adjust interest rates based on inflation, and those interest rate changes can have a huge impact on currency values. When inflation is rising, central banks might hike interest rates to cool down the economy. Higher interest rates typically lead to a stronger currency because they offer higher returns on investments in that currency. Conversely, if inflation is low, central banks might cut rates to encourage spending and investment, which usually weakens the currency. Understanding this relationship is crucial if you want to trade Forex successfully. So how do you interpret inflation data to make informed trading decisions? The first step is to keep an eye on key inflation reports. The most important one is the Consumer Price Index, or CPI, which measures the average change over time in the prices paid by consumers for a basket of goods and services. Another important report is the Producer Price Index, or PPI, which measures the average change over time in the selling prices received by domestic producers for their output. Both of these reports can give you insights into the future direction of interest rates and, by extension, the currency markets. Let's say the CPI comes in higher than expected. This suggests that inflation is rising faster than anticipated, which could prompt the central bank to consider raising interest rates sooner rather than later. As a Forex trader, you might see this as a signal to buy that currency, expecting it to strengthen. On the flip side, if the CPI is lower than expected, it might signal that interest rates will stay low or even be cut, which could weaken the currency. This might be your cue to sell. But it's not just about reading the numbers. Context is everything in Forex trading. For example, a high inflation number in a booming economy might be interpreted differently than the same number in an economy that's already struggling. That's why it's important to consider other factors, such as GDP growth, unemployment rates, and central bank statements, when interpreting inflation data. All of these elements work together to paint a complete picture of where the economy, and the currency, might be headed. Now, let's talk about timing. Inflation data is typically released on a regular schedule, so it's important to know when these reports are coming out. The markets often move rapidly when this data is released, especially if the numbers are surprising. To stay ahead of the curve, make sure you're aware of the release dates and times for key inflation reports in the countries whose currencies you're trading. Many traders choose to avoid entering new trades right before these releases due to the increased volatility, while others might position themselves to take advantage of the potential market swings. One of the best ways to navigate these market movements is by using a reliable trading tool that helps you identify trends and signals. This is where the Apex Trend Indicator comes in. It's a powerful tool designed specifically to help Forex traders like you find favorable trends and profitable opportunities in the market. The Apex Trend Indicator can quickly scan multiple currency pairs and timeframes, giving you real-time insights into market conditions. It shows you whether a specific pair and timeframe are in an uptrend or downtrend, helping you make informed decisions on when to enter or exit trades. What's really great about the Apex Trend Indicator is its ability to provide non-repainting buy and sell signals. This means you can trust the signals you receive without worrying about them changing after the fact. Plus, it offers alerts straight to your phone or desktop, so you never miss an important trading opportunity, especially during those critical moments when inflation data is released. Whether you're a seasoned trader or just starting out, having a tool like this in your arsenal can be a game changer. Another key strategy for interpreting inflation data is to look at the bigger picture. Inflation doesn't operate in a vacuum. It's influenced by a wide range of factors, including global events, government policies, and supply chain disruptions. For instance, a sudden spike in oil prices can lead to higher inflation, especially in countries that are major oil importers. By keeping an eye on these broader trends, you can better anticipate how inflation might evolve and how it could impact the currencies you're trading. Let's not forget about the role of expectations in Forex trading. The market doesn't just react to the current inflation data, it also responds to what traders expect will happen in the future. This is why it's important to stay informed about central bank meetings, speeches, and other communications. Often, central bankers will drop hints about their future actions based on their inflation outlook. If you can anticipate these moves, you can position yourself to profit when the market reacts. For example, if the central bank signals that it's worried about rising inflation, traders might start buying the currency in anticipation of a rate hike, driving up its value even before the official announcement. By staying ahead of these moves, you can capitalize on market trends before they fully unfold. In conclusion, interpreting inflation data is both an art and a science. It requires not only a solid understanding of economic principles but also the ability to read between the lines and anticipate market reactions. By keeping a close eye on key inflation indicators, understanding the broader economic context, and using tools like the Apex Trend Indicator, you can enhance your trading strategy and increase your chances of success in the Forex markets. Remember, it's not just about knowing the data, it's about knowing how to act on it. So, the next time you see those inflation numbers come out, you'll be ready to make informed, strategic trading decisions. Thanks for watching, and if you found this video helpful, don't forget to hit the like button and subscribe to FX Limit for more tips, strategies, and insights into the Forex markets. Keep trading smart, and we'll see you in the next video.